Good morning, subscribers. Um, Today we have Mr. Nimesh Chandan with us from Bajaj Mutual Fund. Bajaj Mutual Fund is one of the youngest fund houses in the country. You all might be knowing Bajaj Finserv and Bajaj Finance. They are all successful players in the finance industry. They have entered the mutual fund industry in the last year with strong balance sheet support and many innovative ideas. Currently, they are managing more than 6,000 crores of assets and coming out with many new launches. As we speak, they just now they closed balanced advantage fund. Earlier, they had come out with the flexi cap fund, and it is doing well, and also many other debt funds. So, Mr. Nimesh Chandan is the Chief Investment Officer of Bajaj Finserv Mutual Fund. Earlier, he has served as Head of Equity in Canara Robeco Mutual Fund. Prior to that, he has worked with ICICI Mutual Fund and SBI Mutual Fund. He has more than 22 years of experience in this industry, in asset management industry. He passionately reads investors' minds and has many suggestions to improve one's portfolio returns. So usually with CIOs or CEOs, we discuss how they manage money, or market outlook, and so on. Instead, today we will focus more on about investor psychology and how to direct it in a useful manner to benefit your portfolio. Welcome, Nimesh. Glad to have you on our channel. I'm sure that your insights will immensely help our subscribers. And I have also read your book, more on investor psychology and all those things. Continuously, you are giving out ideas on how managing one's mindset, and also I heard that you are following in your fund management. I have read your books and other things. So today we will discuss about investor psychology. One of the common patterns as market is going up and increasing, bulls are raising the market. So one common pattern that I have seen with investors is they are afraid when market goes down. That is nothing but normal. But there are investors who are afraid when the market goes up as well. Now, why is it so?
Good morning, Chokalingam sir, and it is nice to be on your channel. Whatever I say is my personal views and ideas that I can suggest investors, but don't take it as investment advice. So that would be my first disclaimer also to put. You made a very interesting point, and what a way to start. So people are fearful when the market goes down, and many are fearful when the market goes up. The concepts that are at play in these two conditions are slightly different. Fear is a very strong emotion, and obviously when markets fall and when money is involved, people do get fearful, and sometimes they react at the wrong time, means they sell at the bottom. And that is when that fear is because when we think of some event, we think of the loss and also the probability of that loss to come in. So many a times we exaggerate or think that the chances of losing money from here on are more. Our perception of risk changes. And that's why we get fearful during down markets. When markets are moving up, something different is at play. There is also another tendency of ours to be loss averse. Most people feel the pain of loss more than the happiness they feel for any gains that they get. So typically what psychologists say is that the pain that you get because of a loss of 100 rupees is much more or double of the happiness you get for making 100 rupees. So people are always loss averse, and sometimes they become loss averse even for short term. Richard Thaler, who is a Nobel Prize winner, called it the myopic loss aversion, that people don't want to lose money the moment they start investing. But markets are volatile, right? And they do correct. So people get fearful that if I invest and the market goes down even for a day, they get fearful for that. So it's that loss aversion in us, but we should think long term so that we can get over that bias.
Yeah, I know you rightly said the particular question I asked because one of our doctor customers, he called at least twice or thrice in the last 1 month. Now he has crore plus portfolio. So now he says that he is certain that he will withdraw the money right now, and just before the elections, market will go down. He is also certain, and at that time he will deploy all the money, which he has been investing for the last so many years. So this is the kind of pattern, erratic pattern. Sometimes I observe, from investors, and they take a chance, and but however they don't think that it will take time to deploy the money. There are practical difficulties when market is going up for whatever reason. If it started rising, yeah, other than our expectation, he expects the market to go down. Our market may go up. We really don't know. But so those are the practical. And sometimes when they take some hasty action, what happens is whatever money they have saved so far, it goes for some other purpose completely. When cash is sitting in their bank account, what they will do is someone will come, they will say some plot is there, something is there, they will start buying that. So the total purpose of investment or the goal is lost completely. So there is a.
You are absolutely right. And this is also very common. It's something that affects every one of us. The thing that one should remember when trying to time markets on these events is that first, do we have a very credible insight into market movements before or after these events, or it is just our opinion? Also, remember that cycles don't exactly repeat themselves. They may rhyme, but they may not exactly repeat. So, last election or election before that, what happened may not happen again. The other very important thing for people trying to time the market is that you have to get two decisions right. You have to exit at the right time, means if the market keeps going up after you've exited, then that is the wrong decision. Also, then you have to re-enter at the right time. So market's correct, but you don't re-enter at the right time. Again, the whole transaction costs and the paying taxes and everything just to get out of a position and then getting in becomes unviable. So I think one has to be very sure that the insight is right and that you are able to get those two decisions of exiting and entry right. Many investors who don't track the markets or don't study the markets may find these very difficult.
So, and the one more thing that I'm seeing is, as a human being, most of us are happy with, short-term returns rather than long-term returns. Say, for example, if someone gets 50% or 60% in 1 or 2 years, they are so happy, they want to redeem it. Even though, we have seen that in the past, staying invested for 7 years, 8 years, they can reap like 500, 600% return. Some of the in equity mutual fund in our industry, I have seen funds giving 99,000% returns, and so on, etc. Even higher than that over the last 24 century. I'm saying, if they had remained invested. But why this thought process of being happy with short-term return than waiting for long-term return?
Again, a very interesting topic. Well, there is something called a disposition effect. That's one of the biases we have. Typically, when we are making profits, it is easy to take those profits. But when we are making losses, it's very difficult to do that, because if you're taking losses, you have to admit that you were wrong and you go through that pain that what mistakes did I make. So people typically don't book losses, they book profits very easily. The second thing that happens is neuroeconomics says that our brains are wired to get excited when we make profits. So there is a chemical called dopamine, which creates euphoria in us that, okay, I made quick returns and very good returns. So dopamine actually makes us excited. We try to book those profits. Those profits may later on we invest in something even more riskier sometimes. So these are again biases that we carry. However, it is important to review investments, say in a year or two, review your portfolio, make the changes which make sense to you. But just because an investment is in profits or losses, or you made a certain percentage, is not a reason to change that investment. As you mentioned in your question, that there are times when a good investment can give you multi-bagger returns over the years if you try to, say, book profits within 10%, 20%, or 50%, you may then regret that you did not stay on with that investment for longer.
True. And one more thing which is common with regular investors is they buy real estate and forget real estate for generations. However, in equity mutual funds, they keep on monitoring. They worry when market goes down, and even the profit goes down. They worry. Say like someone had put like 10 years ago 1 lakh, now it is 5 lakh. If it becomes 4.5 lakh or 4 lakh, they regret so much that they did not redeem when it was 5 lakh. Although we know that, okay, this 4 lakh will become 8 lakh in the future. So that kind of, they make some, they give some priority to real estate. I don't know. So just wanted to touch that topic with you.
Yeah. It is important that you take a long-term view for investments because equity markets especially fluctuate a lot. And the whole system around, the ecosystem around is designed to make you trade more, right? Even on TV channels, they want to attract people to listen to them for every hour, every minute, understand every tick that happens in the market, and that induces you to trade more. Broking companies or stockbrokers also want you to trade more. They want you to take more trades so that they earn their brokerage and the volume goes up in the market. Stock exchanges want you to trade more so that the volumes go up. So the whole ecosystem is designed to make you trade more. Now, if we take real estate as an example, real estate, we are looking for a longer term. It is not easy to transact on real estate. So that makes us stick to that long-term investment much better. Here, because the market access has become easy, people think making money is easy and they end up trading more and losing money actually. And other thing is this is a topic of discussion everywhere, stock markets. So every day people, your friends are telling you they bought this, they sold this. So that creates another temptation to trade and start feeling that, okay, I'm able to time the market. I'll buy at a low, sell at a high, then again buy at a low, something like that. Try this with your real estate broker. Tell him to him or her to stand in front of your window every hour and keep shouting prices to you and see how you react in real estate also. It is important to have the right coach and the right network of people to help you think longer term and stick to your investments.
So, I mean, one of the CEOs from mutual fund industry that I met recently, he was saying that we are selling more of liquidity, rather we should sell more of illiquidity as an industry. So you are saying don't highlight the liquidity mutual fund provides, highlight the return that mutual fund provides, and be little more illiquid than liquid. So that's because of things. Anyway, so certain now psychological factors that an investor should adopt to increase portfolio returns, because today our topic is how to increase your portfolio returns, through whatever our behavior and all those things. So what are the psychological factors that an investor should adopt to increase portfolio returns?
So what I will say will not sound anything new, but these are the basics of investments where whoever has adopted these principles have created good returns for themselves and whoever they are advising. So one of them, the first thing is to think long term. Don't think for near term. Try to invest in the markets for just a short term rally that I expect certain event or market to bounce here or fall here or so. Think longer term. I think 5 years, 10 years, and think of the wealth that markets can create for you over a longer term. You are investing in businesses. Stick with those businesses for the longer term and you will see returns. Second is to have patience. We are not playing a T20 match. We are playing a test match. It is not running a 100-meter sprint. It is like running a marathon. So have that patient, be consistent. Don't there are say methods like systematic investment plans which help you to think longer term and be consistent. Every asset class gives you an opportunity to create good returns, good wealth. But you have to be patient to wait for those opportunities. The crowd gets excited about one area of the market and then takes it to a very high valuation. We are always tempted to follow them. It is better to look at what the crowd is ignoring and then see if the valuations are attractive there and buy those. And the two more things then. Uh, Choose the right strategy that suits your temperament and your goals. And I'm saying both temperament and goals. Of course, you have to reach your financial goals. But if the strategy is not as per your temperament, you may perceive the risk to be higher and you'll be pushed into taking certain wrong decisions at the wrong time. So choose a strategy that suits your temperament and goal and network with the right people. If you are a long-term investor and you are daily talking to day traders or FNO traders, you will not get any new insights, but you will get confused and you will again uh, affect your decision making. So if you talk to the right people who are also thinking longer term, sometimes taking a contrarian position requires that people agree with you. Talk to people who can agree with you and encourage you to take the right steps, like buy when people are fearful and sell when people are greedy. So I would say these four things: think long term, have patience, choose the right strategy, and network with the right people.
No, the one thing, although network with the right people that attracted me the most, or what do you say, like-minded people in the sense, if you are a long-term investor, talk to long-term investor, not a short-term trader. That is a very good valid point, that I like very much. And generally, we in behavioral finance, and in investment area, we tell, okay, investors, okay, these are the generic mistakes, that a equity mutual fund investor do, and some remedies for that. What are the, in your, experience, what are the generic mistakes that you see that investors doing, and how, they can remedy for the same?
Yeah. It is famously said in investments that investing is simple, but it is not easy. Investing is simple. You have to buy low and sell high, right? It cannot be any simpler than that. But it is not easy because of all the emotions and all the biases that get involved while these decisions are being taken. We many a times end up doing the exact opposite. There was a study done by Morningstar some time back where they looked at the investor returns versus the mutual fund schemes or the asset classes that they had invested in. They found that investors on an average made lower returns, somewhere around 150, 200 basis point lower compounding compared to that asset or the scheme they had chosen. Now that happens because you get in at the wrong time and you get out at the wrong time. So I think people make these mistakes. There are a lot of biases that would go into doing this. So there is greed, fear, overconfidence. Some people leverage. These are the common mistakes that people make. There are obviously other biases that come in, but these are the broad ones that people make mistakes on. Now, there are chances that, say, you can control or stop yourself from having such wrong decisions. First, have a right process, a process that focuses you towards thinking longer term. It should make you identify opportunities that provide attractive long-term returns. It should have certain pre-commitments that stop you from acting, say, on impulse. For example, certain closed-ended funds or certain long-term investments stop, like illiquidity, which was mentioned earlier, that instead of highlighting liquidity, we should look at illiquidity. During fear or greed, there should be systems that stop you from acting. There should be certain tools in your process that say, go check again, don't just jump into the trade. And small nudges actually help you come back to the right mind or not act with impulse. I had heard about a case where somebody who was a shopaholic had put his credit card in water and frozen it in the freezer. So by the time he decides to go and buy something, he has to wait to get the glass out, wait for the ice to melt, then get the credit card and then go and shop. So during that time, the person that impulse to buy actually went down significantly. He came back to this senses that, okay, maybe I don't need this. So an investment process, and if you have a right coach or a friend who can help you, is definitely invaluable in these times.
True, true, true. Now, what I tell to our investors is, okay, you know, growing the asset, making money, and all those things is a part of the game, of course. But the most they can benefit from us is when they want to redeem, we will ask a question why. If he or she is doing herself or himself, then automatically, as soon as they think, within 2 seconds, they will execute.
Yeah.
So here they have to call us and we will ask a question why. Although he is redeeming his money, I perfectly tell it is your money. There is no question about it. But we will put a question. We are like Nandi in front of them. Before reaching Shiva, we are Nandi. That's all. So we will ask the question why you want to redeem. Then accordingly we will decide. So that way, yeah, you rightly said that right person should be there. Anyway, so those are and one more thing, as I understood, and when your CEO Ganesh was also here, so we discussed that you are employing behavioral finance certain techniques in your portfolio management as well. So of course, fund managers are also human beings. You have processes, systems, everything, risk management, risk measures, everything. But still, that behavioral finance concept that you have put in place is will help all the investors. If you can briefly explain about it, what are the ways in a different approach that you are taking?
Yes, we are quite proud that we are at Bajaj Finserv AMC. We are able to use tools from behavioral finance to do two things. One, identify our own biases as individuals and as a team and address those biases. The second part is to identify market biases or crowd biases and take advantage of them. So we've created tools on both sides. Some of the tools that help us in reducing our biases is one of them is like a investment checklist. So whenever we want to invest in a particular security, we've created which are the important points we should check before investing in that security. So what we want to check about the business, what we want to check about the management, what we want to check about valuations, their financials, everything is written there so that we don't, in our impatience, we don't miss out on any step. And it is also a reservoir of our previous mistakes. It is very important to learn from your mistakes. So what we do is if we have made a mistake in a decision earlier, the learning from it, we put it into that checklist so that we don't repeat that mistake. Another thing we use is, see, the world looks at only one target price for securities. Stock prices, bond prices never go and stop at one price. There is nothing like one intrinsic value. It is a range of values depending on the future that you are forecasting. So what we try to do is create scenarios. What will be the bull case scenario? What will be the bear case scenario? That helps us understand the risk rewards in a particular security better. Rather than one target price, we create 3 target prices and then put a probability. What is the chance of this being achieved? Another tool we use for sizing the portfolio, it's based on a formula given by John Kelly, where I'll give you a simple example. Suppose you choose the best 11 players for the Indian cricket team, but your batting lineup is such that Virat Kohli and Rohit Sharma come at the end. Now, even if you have great players, you have not lined up the portfolio well, or you've not lined up the team well. So we have these formulas that help us from understanding risk reward to how to create a hypothetical portfolio based on our best ideas, which have higher returns and lower risk. So these are some of the tools we use to reduce our own mistakes. We also use tools that tell us where the crowd has overreacted in greed and fear, or where they have underreacted. Some news has come, but the market has not reacted well to that. So we try to take advantage of those.
Okay. So some of these techniques will indirectly help, investors in bringing up a better return or more disciplined return, I would say. And
Yes.
One of the questions, as we talk about psychology and mindset of people, nowadays people are not asking. Until a few months ago, people used to ask me, will there be a period for Indian market like a Great Depression of America, like 30, 40 years or 20, 30 years? Now the market is continuously down, because whenever they come to us, we generally, go with equity mutual funds. Then they become a little bit afraid. They say, sir, you are suggesting mutual fund for everything. So, if it happens, if it becomes like a Great Depression, like, what happened in before World War in USA, is there a chance to happen in India? That is the next biggest story. So is there a chance? Is there a possibility in the current economic scenario and world?
It is very difficult to predict extreme moves and both sides. So it is very difficult to predict whether we will go into a depression, or whether we will go into, just before depression, there was the roaring 20s when the economy and the markets were booming. So it is very difficult to put both sides. People who worry about it are also acting in a little bit of fear that I mentioned, right? That you give higher probability to events which are rare, and then you start getting afraid of those events. Typically in the market, people fear that there will be a 15-20% correction after they buy. But they don't realize that if there is a 6% inflation, over 3 years, the same money goes out of their pocket quietly, taken out by inflation. So they worry about equity market crashes, but don't worry about inflation eating away their savings. Having said that, economies and markets have their cycles. After extreme boom, there is a bust. After extreme bear market, there is again a boom. So everything is in cycles. Right now, we are in a good cycle for both markets as well as economy. In the near term, I don't see something like a depression coming in, but there will be markers. So people who track the markets know that first the fundamental cycle will start disappointing, and then the markets will react by falling into a bear market.
Okay. And so, I mean, for the with the lowest, the events that have lower probability, we need not worry about. That's what kind of.
Yeah.
Also, it is not in our hand anyway.
Absolutely. It's very difficult to predict extreme events.
Extreme events. Okay, that's well said. And in the current market situation, what are the anomalies that you are observing from an investor point of view, or even from a fund house point of view? Do you see any anomalies, or particularly for investors?
Okay, so I am actually a little worried about a lot of investors who have come in after, say, 2020. They have seen the market move only higher, and which is where they have this possibly overconfidence that markets will not come down and they will only make money by putting more and more money into the markets. Second thing, what has happened is people have leveraged a lot. A lot of activity is happening in options, for example, in futures and options. And though statistics don't say that people are successful there, SEBI report said 89% of them make losses. But people are tempted to get into leveraged bets, which is again a worrying sign. Third is like a gambler. People are taking markets as a financial video game. A lot of them, I'm not saying all, but a lot of them. See what happens in a gambling instinct. You take 100 rupees in your pocket to the casino. Suppose you make another 100 rupees very easily. Now, you treat those 100 rupees as profit and take more risk with that. So, even a gambler puts the principal amount in one pocket and profits in another pocket, what we call as mental accounts. And that gambler will take more risk with the profits that he or she has earned. And that gets into a cycle of higher risk taking. So these are the things I worry about, that people are trading too much, people are taking leverage, results are not good in them, and because they have not seen a sharp fall in the market, this continues. Not predicting a sharp fall in the market, but I worry that whenever it comes, it will be painful for some of these investors.
Yeah, because they are putting their life savings into these investments or markets. A lot of them are youngsters, particularly youngsters. After becoming online, everything is online, so it's easy to access, open demat account, trading account, do trade.
Yeah.
So better with a
Just
lot of.
because you are absolutely right, just because access to market has become easier, people think making money in the markets has become easier.
Those are a little different. Yeah.
Yeah.
So, very good. So far, we have been talking about all these psychology of investors and better portfolio returns, how patience is needed, etc. Now, just you are a fresh AMC with a huge backing and all those things. People have a lot of hopes, and that is good, and that shows in your numbers. Sorry, already within a short span, your assets under management has grown to 6,000 crores. Just tell us about Bajaj Finserv AMC, and just give an overall view for our subscribers, who are viewing this program.
Okay. Typically, I tell people that we are a new AMC with novel products and innovative process. We are a new AMC, and we pride ourselves that we have a late mover advantage rather than the first mover advantage. People pride in first mover advantage, right? But we believe that being a late mover, we know the kind of positive things that the industry has done. Also, we know some of the mistakes that have been made. So, at the very foundation itself, we are putting those learnings and creating an AMC, which we believe and we hope that the investors also see, have certain strong founding principles on which we have created this. The second is we are coming out with products which we believe are different and better for our investors. Even in the products that we have launched, say a flexi cap fund, if I take for example, here we have used a strategy called mega trends investing. This was not a strategy used in India before. This is about true long-term investing. What a true long-term investor wants to be with companies that will benefit from all the changes that are happening in economies and businesses. So we created one specific fund for these long-term investors by identifying companies that are on the right side of these long-term changes, whether it is technological innovations, regulatory changes, economic changes, consumption changes. So we created those products. So we came out with something novel. I also mentioned that how we have used behavioral finance in our process to improve our decision making. Benjamin Graham had once says that temperament is almost as important, if not more important, than knowledge in investing. So how do we handle the psychology behind decision making? So we came out with an innovative research and fund management process, both for fixed income and equities, which takes these tools from behavioral finance to improve our decision making. So this is what Bajaj Finserv AMC has brought till now for investors.
Okay. Very good. There is the mega trend. So you want to side with the trend, so which automatically makes money in the sense, kind of. Again, you have to choose companies, pick companies, everything, but you are identifying the trend, and then accordingly you are aligning your portfolio with that. That is a good thing. That is a novel idea. So, and about, say, for example, right now you manage flexi cap, already, and balanced advantage fund has come. I think yesterday or day before yesterday, you have closed the NFO.
Yeah.
And a few more debt funds are already there. In the flexi cap, now you will be investing in large cap, small cap, and mid cap. So right now, where is your inclination in your particular fund? Because mid cap, small cap is overvalued or large cap is undervalued. How do you see it?
So we are first focused on long-term investment. And as I said, first we try to identify the mega trends or long-term changes that are going through in economy. So for example, technological changes, AI, robotics, even electric vehicles or UPI. We identify those changes and then identify which are the companies positioned to make most out of these businesses. If there are companies which are working on AI or working on robotics in manufacturing, say, companies that are using UPI payments to the best. So some of these we identify, we evaluate them on a bottom-up basis and then put them into portfolio. Now, we also firmly believe that the market cap of a company doesn't tell you anything about the long-term potential of that company. A 5,000 crore company or a 20,000 crore company or a 1 lakh crore company market cap. That these numbers will not tell you what returns you will get out of them over a longer term. It is a business that will tell you whether you make the returns on these companies. So we focus on businesses. Now, right now we would have a large part, say about 52% of the portfolio in large caps and the rest in mid caps and small caps. So 48% in mid caps and small caps. Now, we have chosen these companies not by looking at their market caps, but looking at their businesses. Which are the businesses which have strong tailwinds and have the potential to deliver good profit growth. And a lot of things affect the movement of stock prices over 5 years, 10 years. But the most important factor is profit growth. If that company is growing in profits, ultimately stock prices will go there. Even if near term it may go down, but over the longer term it follows that. So we identify these companies. Now think about it. We have to create a portfolio of say 60 companies, out of which say there are totally there are 150 mid caps. We have to identify 15 mid caps which have the potential to become large caps or do well over the years. Out of 250 small caps, we have to identify 25 which can become good return generators for us. So I believe that rather than looking at market cap, focus on businesses. Yes, market cap does tell you about the liquidity and the volatility that can happen. So that's why small cap people get scared of because of volatility. But if you have a good company, then near-term volatility becomes an advantage that you can use. So that is how we have created our flexi cap portfolio.
Okay. And do we have something new which can be shared with subscribers about the forthcoming, NFOs or your plans, in the next 6 months or 1 year?
So you can be rest assured that whatever we bring for our investors, we will come with a product that is slightly different and better for the investor. In that category that we come out with, what do the investors need in that category? We study that. We study which is the style most suitable for them or the strategy most suitable for them. We also look at what kind of risk they carry and try to see how we can mitigate that risk of that style or that strategy. I will not be able to reveal the exact funds that we are coming out with, unfortunately, right now, but we have an open canvas. One of the other things we also are conscious of is that we want to bring the product at the right time for the investor. We can go and tell the investor, yes, from here on, there is a potential to create wealth in that category. So that's why we are launching it, not just because that category is big or small, it doesn't matter.
Okay. And your headquarters right now is in Pune. I think you are the only fund house in Pune, if I'm right, headquartered. And we have some fund houses in Chennai. Of course, Franklin Equity Team is here, Sundaram is here, some fund houses. So that way, why is it because the group companies and group everything is in Pune that you have decided to be in Pune, or Is it Bombay is overcrowded that you decided to move to Pune?
So I tell a lot of people that Warren Buffett is not sitting in Manhattan, New York. Warren Buffett is sitting in Omaha. Closeness to the say Dalal Street or Wall Street is not really a condition for being a good investor. So we believe that Pune, uh, being based in Pune, we are able to create a good team here. We are able to attract good talent. Uh, we somehow have, like, now because of connectivity, anyway, you are in touch with everybody, right? Through your video calls or
Yeah.
conferences that you do virtually. But this gives us a little space away from the noise also. We are sitting in Pune where there is less noise about the markets. We are able to really cultivate these ideas of thinking longer term, reducing noise in our decision making, focus on the right things. So that is helping us a lot. And apart from the good weather,
Good, good. That is great. And of course, before getting into the Q&A session, having CIO in our panel and not asking market outlook when things are really hard will not be that great. Just want to understand, markets are shooting every day and people are yesterday one person, one of our investors who has gone to Malaysia, he called me from there asking, I have shown these returns to the Chinese people. They are asking if I can invest in India directly through you. I told right now not possible. Wait for some more time. Gift City is coming, and our fund houses will open in Gift City. Then at that point of time we can think. So it is so hot right now, and people are sitting with huge profit right now, and it is good. And people understand that yes, markets can go down also, but how do you see from here for the next 6 months, 3 months or 6 months? How do you view? It could be liquidity or, is there any pending danger there? So how do you see, just to, give your outlook?
so if I just take one first a long-term view, and then I'll probably give you an idea about what I see in the next 3 to 6 months. On a longer-term basis, uh, in my career, I have not seen India doing so much better than the rest of the world. Yes, in 2003 to 7, we did very well in terms of markets and economy. But there were other dozen countries which were doing well during that time because the global situation, inflation was benign. You were seeing good growth globally, a kind of a virtuous cycle that the globe was in. At this point of time, we are seeing so many developed economies facing slowdown, high interest rates. There are problems of high debt, leverage, bankruptcies in many of the countries. In India, we are seeing very strong macro stability. We are seeing earning stability. See, it doesn't mean that you have to have very high earnings growth, but you have less volatile earnings growth also. Valuations, I believe we are at the reasonable level, more like a fair value level. I don't think we are in the bubble zone at this point in time. Our banking system is good. Corporates are raising money so that they can deleverage or strengthen their balance sheets. And we are seeing a lot of important trend changes in India. Like, for example, our per capita income going from, say, we are looking for it to grow from $2,500 approximately right now, so about 2,400, going up to 4,200 and then $5,000 in, say, 2030 to 2033. Now, these are changes which will change India significantly. Like, the discretionary spending goes up, the way people save and consume changes, and there are so many businesses that can benefit from that, and the economy can do well. The changes we made in terms of taxes, in terms of GST, are now helping us. Like, the revenue collections are good, compliance is better. So all this is changing and helping India. So I believe India is on a very strong footing. In the near term, however, the focus of people naturally will be politics and geopolitics, the kind of events that are going up around the world. People are more focused about what's happening in the Middle East, what's happening in Russia, Ukraine. so many countries are going through elections, right? The major economies like UK, US, and India, all three will go through elections in the coming year. So people will be focused on those areas. That does create its own volatility. So I think long-term investors have to take volatility as a friend rather than as a risk. Volatility is when short-term speculators are panicking about something. They will overreact on the downside sometimes, and a smart, well-calibrated long-term investor can use this to create a good portfolio. So I believe in terms of valuations, we are close to fair value, but markets do overshoot also. It's like a pendulum that swings between greed and fear. Even if the steady state is in the middle, the pendulum doesn't stop there. It moves on the other extreme then. So I believe that we are in a good situation. For the near term, valuations may be at fair value, but I expect that people to take a longer term view and the markets to continue to move up.
Great. So one input, if I can take from that, is markets are not overvalued yet. They are in fair value.
Absolutely.
That gives comfort to many investors. That is good. We will get into question and answer session right now, Nimesh, and it will be for a few minutes. Before that, if you want to share any of your hobbies or anything that you do out of office, anything which is personal to you, you want to share?
Well, I am actually so much involved in my own field. I kind of what Warren Buffett says, I tap dance to work. And I continuously read and think investments, and behavioral finance is one of my favorite topics to read about. So I keep reading about investment psychology. See, there are four things. If somebody is interested in reading about markets, there are four things that you should read about to understand markets better. You have to read history. You have to read about businesses. You have to read about psychology, and you have to read about market concepts like valuation. So these are the four major areas that create the knowledge about or understanding about the markets. So if you pick up any of these topics, your knowledge will not go any waste. It will be useful in one way or the other in your decision making about investment.
Very good. Thank you. And just a minute, let me know there are some questions coming up here, and let me see here. Someone is asking, business control laws, business control. Is it fair to say that only the paranoid survives in the market?
No, in fact, I would say the opposite. People who are stoic actually do better in the market than people who are paranoid. So I think the book that a person refers to is about a certain business or innovative businesses. But in markets, see, the investment principles are like written maybe 100 years back. The good principles about investing. There is a 100-year-old book. I'll just get the name. So it was written much earlier. It's the best book on personal finance, but it was written like 100 years back.
Okay.
And a lot of learning from the markets the principles are the same. It's just that you're using different tools and innovating certain processes that help you implement those principles a little better. A stoic is a person who doesn't react with extreme emotions. And I think that is required for being a good investor in the market.
Thank you. Then there is a question. Hello, sir. Tell me about multi-cap fund. Can I invest in SIP?
So we have a flexi cap fund. I think the person wrote multi-cap by mistake. So we have a flexi cap fund, the Bajaj Finserv flexi cap fund. Of course, SIPs and STPs is something that I myself recommend to people that this is a good way of investing because it not only helps you build wealth over a period of time, it obviously helps you mathematically averaging, but it also is psychologically comfortable. Not that I'm against lump sum investments, but for a lot of people, SIP fits the bill because it is right for their goals and also right for their temperament.
Then how your balance advantage fund is different than others?
Very interesting question. So we are the first balance advantage fund in the country which uses behavioral finance tools, understanding the market biases while allocating money within equity and fixed income. So as I said, there are two things, important components that move the market. One is fundamentals, which has everything about economy, corporates, banks, like your GDP, credit growth, profit growth, everything there. The other is the sentiment, where or liquidity, where people act based on what they think. Now we captured how markets are thinking, or crowd is thinking about the markets and economy and businesses, and then we allocate on that. So if you see a pendulum, as I said, we try to capture not only the steady state of the pendulum, but which side the pendulum is moving. So we may get uh, an opportunity to sell when people are greedy and buy when people are fearful. It should not be like we are selling immediately as the market is going up and buying when the market is falling. See, many a times, just because market is rising, you don't have to sell. Just because market is falling, you don't have to buy. You have to understand what's happening there. So you have to sell when people are greedy and buy when people are fearful. And to that extent, you have to understand the market psychology. And that's what we do in our balance advantage fund. We use fundamentals and behavior to create a portfolio.
What is the expected return if present political regime continues in the next term of 5 years?
So I will not be able to forecast a return for you, but I will also add a little bit on this. See, while we have very strong political stability for now many years, and that is expected to continue, that gives comfort to a lot of investors that policies will continue the way they are. Whenever there is a regime change, not that we expect something negative to happen, but policies do change when certain governments come in. So that's where the market gets worried. Markets don't like uncertainty, and that's why they react very negatively when there is a change that comes in. Now, because of the current elections results on the state side and all that, the market has already discounted that the current political regime will continue. So I don't see now that being an important factor. It's a comfort factor, but I don't think that's an important factor to drive the market higher. Now, when the new government comes and puts a new budget, that's when investors will start reassessing that what is it that the government wants to do for the next 5 years, and then start pricing in those things.
Okay. Can we say that say like the GDP growth rate plus inflation put together say like 7+5 or 6+6, whatever it is, that 12% ought to be given by the market? Can we say that?
So I have tried to use these rule of thumbs earlier that we typically take nominal GDP. So what the person said about real GDP plus inflation. Typically, we also focus, say, for a steady return, steady growth, a 10 to 11% nominal GDP growth, and then we look at the market returns. But we found the correlation between GDP and a near-term correlation between GDP and markets to be very weak. You see, GDP has certain sectors which are different from the market or the index, for example. Agriculture is an important part of GDP, but is not there in Nifty. If you see, IT is a very large part of Nifty, but a small part of GDP comparatively. So there are a lot of things like pharma also. Pharma is a large part of the Nifty, but small part of the GDP. So these things, these differences over a period of time create a big difference in terms of market movement and GDP. I would say if you are looking for one strong point to follow, is follow the profit growth of Nifty companies. Read about how the profits are growing quarter on quarter for Nifty. That will give you a better sense of the market than just looking at GDP.
Okay. Then there is another question from S. Balaji. 2023 is PSE index. In 2023, PSE index delivered good return. In your view, which sector will deliver good return in 2024? How much impact general election in equity market? Anyway, general election you have answered. Which sector will deliver good in 2024 is good question.
So as I mentioned that many a times, I'll take a slightly more behavioral approach here. When people get excited about a certain sector or a certain theme, they tend to overprice it over a period of time. So then following the crowd, that when they have overreacted on something becomes very dangerous. But when crowd is focused on one thing, something else is getting cheaper or getting ignored. I believe that both equity markets and fixed income markets provide such opportunities at areas where market has not looked at. So in the equity side, we believe that consumption is an area which is a good long-term story for India's growth. Has not got much focus recently. So I think Indian consumer stocks or consumption sectors are something that one should review at this point of time. There are certain areas like, for example, defense or public sector units and all that. Here you have to be a little careful because some of the new listings and some of the price movements have been quite spectacular. So here I think one needs to be a little careful in choosing. Not that you will not get the good businesses or companies there, but you have to be a little more careful there. Consumer is one area where I think there are opportunities quite a bit. Banking and financial services is an area where I see good opportunities. I'm more bullish on domestic sectors than compared to export sectors also. Coming to fixed income, I think about it like, you're getting a 7-quarter on government security on a 10-year. And if you take AAA portfolios also, you are getting 765, 770. We are at the peak of interest rates. We are looking that in the next year, sometime next year, there will be a cut in interest rates. So even fixed income mutual funds will give you good returns if you take a certain medium to long-term duration. So I believe both markets have opportunities, but you have to identify the pockets which are mispriced and avoid the pockets which are overpriced.
Okay. Good. And now, I think you mentioned already, but someone is asking certain good books on behavioral finance.
Okay, so there are quite a few. What I will suggest is that my team will send you a list, and maybe you can circulate to your investors and audience that have joined today. Yeah, I think it's better rather than me saying all the names. It's better that you
Okay,
get.
then we will post it.
We will post the list.
Yeah, sure. Large cap funds have been very rewarding over the last 3 years. Should be hold or sell. If you want to skip some questions for related reasons, we can skip. Not an issue.
So again, I said that don't just look at market capitalization. Look at businesses or the portfolio that is created. And also for a longer term, your fund selection should be based on your goals and the strategy that suits you the most.
There is another person, Kailash Srinivasan, he is asking the same question in a different way. Sir, given that we have been in a continuous rally in small and mid cap space, is it overvalued? with respect to large cap. Large cap the preferred avenue for investment at this moment.
Okay, so then let me just mention quickly that people feel that small caps have rallied a lot, and that's why people are recommending large caps. Some of the ratios that we look at, we find that small caps are trading at above average valuation compared to large caps, but they are not all in a overvalued zone. So even there are opportunities in small caps to look at. They are not in overvalued zone. And hence, when we are also creating this flexi cap portfolio, we have a participation from mid caps and small caps. As I said, you have to create the right portfolio of companies. It is very difficult also to put a certain valuation target on small caps because they are such diverse companies and sectors. Some are profit making, some are loss making, some are superbly steady growth, and some are extremely volatile growth. It's very difficult to put one valuation number to all these businesses. However, I would say in terms of the recent rally that has come, they have gone above average of their valuations, but they have not gone, all of them, the index has not gone into overvalued zone as per us.
Okay. Okay. Thank you. There are some more questions coming. Anyway, we will give it to you later. I promise you that I will cut at 11:45. You have other appointments, so I have to also go. Anyway, thank you for taking 65 minutes of your time, precious time, and sharing your knowledge with our investors. This will go a long way. And I wish the youngest kid on the block, Bajaj Mutual Fund, to become much more bigger and manage lakhs and lakhs crores of rupees. Best wishes, and thank you very much for participating in this.
Thank you very much. It was a pleasure being on this call and very interesting questions, I must say. And I hope the audience found value in that. Thank you so much.
Thank you. Thank you. Have a good day, Nimesh. Bye.